We now turn to examine put options, the analysis of before the before the great financial crisis, during the crisis, and after the crisis. The pattern for puts is very similar. The only difference is the lower the strike price, the further out of the money the put is. And so remember that the put gives you the right to sell. Therefore, as I lower the strike price, the value of the option is lower because it's further out of the money. What we observe quickly is that the option price tends to zero as I go further out of the money, and as I go further in the money, the put mid price tends to the higher lower bound, which in this particular case is the intrinsic value. Remember, these are options on the SPY ETF. They're American style, and so I can exercise them early. During the financial crisis, once again, we see the option premium or the option price is significantly higher. With the spike in the dividend yield, we see a reversal of the lower bound is now higher than the intrinsic value. It's difficult to see, but the mid price is tending towards that higher lower bound. When markets get back to quote normal, we again see the pattern. Even though the European style put lower bound remains higher because interest rates are so low, the put price tends to that value. And so once again, we do see that the asymmetry in time value, this is going to turn out to be an important aspect of option pricing when we get into valuation models. And so before the financial crisis, if you'll notice, there's more value here with lower strike prices than higher strike prices. During the financial crisis, time value is significantly higher. The asymmetry is less clear. And then after the financial crisis, the pattern is actually still quite high compared to before the crisis. You see this is the peak is below $5. After the financial crisis, the peak still remains above $5, and so the risk appears to be higher for the post-crisis than the pre-crisis. If we turn to put-call parity bounds, because these are American-style options, the boundaries are much tighter. The key insight at this point, since we haven't gone through the mathematics yet, is that the mid price, the normalized call price, does lie within the range. And so it appears as if arbitrageurs are active in keeping the normalized call price within the lower and upper bounds of put call parity. During the crisis, even though markets are in quite a bit of turmoil, the bounds, the option price does remain within these bounds, although it is very close to the lower bound. It is not that close. It is still staying within it. After the financial crisis, once again, we find that the normalized call price does stay within the bounds of put-call parity. We now turn to the quantitative side of this particular material. We'll look at lower bounds, upper bounds, differences in strike prices, differences in maturities, and then put-call parity. The way this is going to work is we're going to assume the boundary condition is violated. If that means there is arbitrage profit available, we'll rearrange this expression to be greater than zero, so that from a cash flow perspective, it'll be money in my pocket at no risk in the future. If I implement the implied trading strategy, I have a guaranteed positive initial cash flow, and I need to check to make sure there's no future liability. If possible, disequilibrium and arbitrages will aggressively pursue this, driving the market back into equilibrium. So what are some of the boundary conditions? The European style lower bound, the call price has got to be greater than or equal to zero, or the stock price minus the present value of the dividends minus the present value of the strike price. The European style put is similar, except for in this case it is the maximum of 0 or the present value of the strike plus the present value of the dividend minus the stock price. And so if you'll notice, there's a sign change here. For American style call options, we have 3 conditions. We have the intrinsic value, that is S minus X. We have the European style lower bound, or 0. Whichever one is greater, that will be the American style value. And then with the put option, it's very similar, except for the patterns are reversed. It's X minus S instead of S minus X. Just to illustrate this briefly, the European style call lower bound, if in fact there's a violation, what I will do is I'll short sell the stock, I'll lend the present value of the dividend and the present value of the strike, and I'll buy a call option. The net will be a positive cash flow by assumption. Again, I've assumed that the lower bound was in fact violated. If it was, then that stream of cash flows by assumption will be positive. The dividend payment required by the short seller, if you short sell a stock, you're responsible to pay the dividend to the person who loaned you the shares. That money will be received from the proceeds of lending, and there'll be 0 cash flow there. If it's European style, I don't have to worry about early exercise. And if you'll notice that these 3 transactions result in 0 cash flow in the future if the stock price is above the strike, but it results in X minus ST if the stock price is below the strike price. Notice, because of this assumption, this is positive by column is the way I say this, ignoring this equality sign. And so I don't mind this at all. I received money today. There's a chance I receive money in the future. Notice that this set of 3 transactions has actually produced the payoff on a put. And this is where we get the put-call parity result that we'll look at later. In the case of European style put lower bound cash flow table, again, we've assumed that the European style lower bound is violated. If that's the case, then this stream of cash flows will be positive by assumption. There's no chance of a future payout. Hence, we would call this arbitrage, and that should not last very long. Once again, notice I've synthetically created a call option. Again, this is where we get the notion of put-call parity. The upper bounds are just not binding, but you would expect a European style call to be less than or equal to the stock price minus the present value of dividends. Clearly, why buy an option on a stock when you can just buy the stock? In the case of a put option, why would you pay more for the put than the present value of the maximum payoff possible? With an American style call, you would expect the call price to be less than the stock. With an American style put, you'd expect the put price to be less than the strike price. You can demonstrate this, again, with arbitrage tables. I don't want to take the time to actually go through these boundaries because they just so rarely come into play. I would encourage you to work through them, if for no other reason, just to get more familiar with option boundaries. There are several other boundary conditions, just by way of completeness. The European style call difference in strikes. The present value of the difference in strikes should be greater than or equal to the difference in the call prices. With an American style, there's not the present value. In the case of puts, it's the high strike minus the low, and it's the difference between the put on the high versus the put on the low. There are several boundary relationships due to the difference in maturity time. If we assume that T2 is greater than T1, then a European style call option with maturity T2 should be greater than or equal to maturity T1. The same is true with a American style call option. For a European style put option, it's unclear. It's ambiguous because you have 2 competing issues. The more time to maturity, the more valuable the put is because it might go deeper in the money. But the longer it is till the option expires, the present value of whatever the payoff is kicks in. And so it's ambiguous whether more time is better. With an American style put, more time is in fact better. There are boundaries related to differences in exercise prices. Without going into it in great detail, it has to do with the convexity of the call price relationship or put price relationship. And you can establish where the middle strike price should be relative to a weighted average of the low and the high. Put call parity, if it's a European style option, then the put call parity is an exact equality. One way to write this is the call option plus the present value of the strike should equal to the stock less the present value of the dividend plus the put. You could think of this as buying the stock and buying a put. This is known as portfolio insurance or protective put buying. You get the same payout if you just buy a call option and invest the rest of the money in the bank, specifically the present value of the strike price. In both cases, if the market goes down, then you have a fixed amount of money that you'll receive. If the market goes up, you'll be able to enjoy the upside. With the American style put call parity, you end up with boundaries. There's a host of different ways to represent these boundaries, but they are fairly tight, and they're tied to the present value of the strike price and the present value of the dividends, as well as the other features. And so the left-hand side here is more on the European style, assuming I don't exercise it early, and the right-hand side reflects some potential early exercises. And so basically you end up with a range of possible call prices as opposed to an exact value. The put call parity table, if you, it turns out if you lend, sell the call, buy the stock and buy the put, then you end up with this stream of cash flows. Remember, we're taking a cash flow perspective, and so it's important that this is cash flow, not investment. And so the cash flows at expiration are zero. Therefore, what should be the present value of a portfolio that offers zero for sure? Well, it should be zero. So if the sum of these values is positive, then execute this trade. If the sum of these values is negative, then you should do exactly the opposite. So if the sum of these values is negative, then I'm going to borrow money, buy the call, short sell the stock, and sell the put. And I'll turn that negative into positive. The American style put call parity cash flow tables, again, you end up with boundaries. And so in this particular case, if the lower bound is violated, or if this particular boundary is violated, then I end up with a positive cash flow. I'll receive interest so long as the option is not immediately exercised. And if we go past the dividend payment date, I'll also receive that dividend. At expiration, there'll be no cash flow. The case two, the other side of this expression, if I do these trades, I end up with positive cash flow today. If time passes, I get interest on up until it's early exercised. And then if it makes it all the way to expiration, I get interest on the strike price. If we look at some selected evidence, the American style call converges to the European style call lower bound. The American style put converges to the European style put lower bound due to high dividends. Time value is more pronounced for lower strike prices, and call and put prices within the American style put call parity bounds. And so again, we're going to normalize the option values. And so basically the ratio of the call to the stock should range between 0 and 1. The ratio of the put in the stock should range between 0 and the strike price, which should be significantly less than or significantly greater than the strike price should be significantly greater than the stock price. And we could also normalize put call parity. And so by way of review, we looked at the role of the arbitrageur. We explored numerous boundary conditions and introduced the cash flow table and looked at some evidence.